Hi everyone, let's have a look at my low time frame and micro bullish and bearish Elliott Wave scenarios on Bitcoin. Starting with the triangle, as we now have a three-wave move to the upside, and one could argue that wave E is therefore in, finishing the triangle in an A, B, C, D, and then finally a wave E. However, from an Elliott Wave point of view, this triangle is not nice at all, mainly because of the volume, which for me invalidates this triangle, and also therefore my preferred scenario is basically a potential fake out of the triangle. So let me explain. A couple of rules are mentioned above. I go in detail into these rules in the previous video. I just want to talk about the invalidation, which for me is mainly the volume decreasing rule. So in a triangle pattern, what you want to see is a higher amount of volume in wave A, and then as wave B, C, D, and E are forming, you want to see volume declining. However, if we look at the volume of this wave A, it is very low, and then in wave B you can see volume started increasing while the pattern was evolving, and that is not something you like to see in a triangle. And then we have a spike over here, and over here volume is higher on average than we saw throughout this wave A. So that's not really something you like to see in a triangle. And also another reason why I'm not usually a big fan of obvious triangles, because you see this triangle all over the internet, is because of the fake out. So what do beginning traders learn? They learn trend lines and they learn patterns. However, if we think about how many traders win in the market, it's usually not 100%. So what I'm thinking is this is a very obvious pattern that we see everywhere. So I would really enjoy a fake out either to the up or the downside. I don't care about either or, but maybe preferably, as I still expect a bit more downside with my preferred scenario, which I'll explain in a second, I would like this wave E to be in, and then everywhere on the internet you're gonna see finished triangle, you know, and then price is gonna move to the downside. And if it's gonna break this trend line and then close a higher time frame candle below, you have the triangle shorters, right? They do something like this, stop loss somewhere over here in the triangle, whatnot, and then eventually trading it to the downside. Now, I'm not saying it's impossible because, hey, probabilities, but what I would prefer personally is a move to the downside to then maybe hit the daily naked point of control at 26,350, Atlas template, daily naked point of control 50 ticks for the ones interested, and we have a low over here as well, for then a bounce to the upside. So it's a fake out of the triangle, moving down out of the trend line, people shorting over here, but then price is reversing to the upside. And that is something I like to see, because in my preferred scenario I am still looking for more upside. Of course, price could just do this, that's fine as well, but I think it would be so nice to just fake out the triangle. That would be really brilliant, but of course we don't know what price wants to do, right? So if we then go to my preferred scenario, I now kind of changed it a little bit to the triangle scenario, where we then have a three-wave in a wave W, and then inside the blue X, as we are looking for a WX and then a three-wave up for Y, inside this blue wave X we then have a three-wave in W, then we have a three-wave structure in a wave X now finished, which is then the high of wave E, remember, of the triangle. You gotta keep the triangle in mind over here. So this is now the high of wave E in the triangle, but in my count it's a wave X, for then now a wave Y to the downside, potentially breaking then that lower trend line, making everyone really bearish, breakout shorters. But this area over here is the most common target area for wave Y in white, which is taken from the high of W to the low of X to then the high of that wave X, or actually I put it on here at the moment. But this area in general is a very important area for wave Y, which then includes that daily naked point of control, includes the low over here for maybe then a liquidity grab, hitting the point of control, and then a move to the upside. Therefore, faking out the triangle, people. End of wave X is in over here, and then we go up in three waves for wave Y. So that would be something I would prefer, because I would prefer to basically see a fake out of that triangle. Of course, wave X could already be in and can be put over here, where this then is a wave W, then we have a wave X, and then this structure over here is a wave Y. It is a three-wave move to the downside, and also the minimum target and also a common target for wave Y being the 0.618 has been respected very, very nicely. So of course this could be then the end of wave Y and therefore the end of wave X, after which we then expect now already continuation to the upside. Absolutely fine with that, you know, no problem at all. However, this wave Y, as you can see, is very, very short in time compared to a much larger wave W and also a larger wave X. Now, X can be any size really, but compared to this W and this little Y, I prefer Y to be a little bit bigger. So what I think would be nice is to have wave X finishing over here, and then wave Y still in the making. Now keep in mind that wave Y then, if it is still in the making, can be any corrective structure including flat potential, which means that a flat can be a 3, then a 3, and then a 5 wave move down. Imagine this happens with the triangle. Just imagine, it gets me excited. Just imagine this happens, right? So look at this scenario and now look at the triangle. What's happening? So we move to the downside. We move above the upper trend line. People are like, oh, potentially longing over here. Boop, breakout shortest because the trend line has been broken. Then we get the expanding flat 5 wave move to the downside. Now the lower trend line is broken, so everyone goes short. But then this is the reversal area for then the end of wave X, and then boom, we go to the upside. So it's like taking both sides out of the market, the longs and the shorts of the triangle. That would be ridiculous, honestly. I don't know what the probabilities are, of course, because we don't have the price action yet, but I think that would be a very interesting scenario to say the least. So yeah, this is definitely a scenario I'm looking for. And if we then look towards the upside, I have two main areas of interest then for the wave Y, if price is going to find more upside, which first of all are the highs over here at about 28.3K, and secondly the target box over here, which sits between 28.9K and 29.2K for some nice additional confluence. If we then go to the micro time frame, I want to talk about the structure to the upside. So of course we then have over here a 3-wave structure up, 3-wave structure down, and now we have potentially this 3-wave structure up, which is already finished, because in my preferred scenario over here, I actually forgot to talk about this. In my preferred scenario, you can see I have some confluences in this area, and in this wave X, we then have another WXY scenario where the, again, common target for wave Y is the 0.618 taken from the low to the high, to then the low over here. And as you can see, price has respected that 0.618 very nicely. We also had the daily, and we had the golden pocket over here as well, taken from the high of this W to the low of this W. So a little bit of confluence, interesting confluence in this area, and we have to wait and see what price is gonna do next. As mentioned, if it continues pushing, I'm absolutely fine with that, but a fake out is definitely something I'm keeping my eye on. And then on the micro, looking at this structure, I first in my previous video was thinking, well, when let's see, price was like somewhere over here at that moment in time, I was like, well, this could be a potential 1, 2, 3, 4, and then a wave 5 to the upside. However, price kept dropping to the downside, and it invalidated a 5-wave structure. Why? Because this move to the downside for a potential wave 4 is too deep. If I pull a fib from the potential wave 2 over here to then the high of this wave 3, you can see that the low that was made is, there we go, is inside the golden pocket, which is too deep for a wave 4. So therefore, this cannot be an impulsive structure anymore in a 1, 2, 3, 4, 5. So therefore, I'm then thinking about a 3-wave structure, which then is over here, a wave A, a wave B, and potentially already a finish C, where the most common target area for that wave C has been hit between the 1 and the 1.236, taken from the low to the high of A to then the low of this wave 4. And also locally, we are creating some bearish divergences, but you have to at least take it with a little bit like a grain of salt, because we also have bigger bullish divergences. However, more local divergences usually have a tendency of playing out. So we have over here lower lows or lower highs, as you can see on the CVD chart, lower highs. But if we check out the yellow line, you can see we have a higher high on the CVD line, right? Higher high on CVD, lower line on price, bearish divergence, which can potentially then create that bearish pressure for eventually more downside. And that can then also be interesting in confluence with the divergences that we have over here on the higher 1-hour time frame, where we have still the bearish divergences that didn't play out between the highs over here and the lower high created, lower high on price, higher high on the CVD, bearish divergence, target 26.3K. If it reaches that level, we can say it has played out. And as you remember from my preferred scenario, reaching this area can be quite interesting. So that would mean the bearish divergences would play out. However, we also have the bullish divergences. We have the bigger bullish divergences between these lows over here. So higher low in price, lower low on the CVD, target 27.6k. And then we have the second bullish divergence between this low over here and this low over there. However, from experience and statistics, the first CVD appearing has the highest probability of playing out. Now, the first CVD appearing out of the bullish and the bearish one is this one over here. So currently that CVD has the highest probability of playing out. And it doesn't matter if price moves to the downside here, the invalidation of this bigger CVD is here, all the way at the low at about 25.8k. The second CVD that appeared were the bearish divergences, and the third one was this bullish divergence. So it has to be said that these bearish divergences came before the second bullish divergences, and that's also an important little detail, which means that between these two, the bearish divergences at the moment have a little bit of a priority. So this one is number one, this one is 2, and this one is number 3. So I hope this video was helpful or valuable to you. Please check out the macro and the high time frame video if you're interested. And for now, thanks for watching and subscribing, and I will see you at the next one. Bye bye.